All right, so today I wanted to make a video on a stock that I've never talked about. I just kind of came across it when going through some screeners, and this is CDW, and the ticker symbol also CDW. Again, they are a electrical equipment company, $31.65 billion market cap currently, dividend yield just over 1%, free cash flow yield of about 4.5%. Again, if we read the description here, CDW engages in the provision of information technology solutions to small, medium, and large businesses, government, education, and healthcare customers. Array of offerings ranges from discrete hardware and software products to integrated IT solutions and services that include on-premise and cloud capabilities across hybrid infrastructure, digital experience, and security. The firm's business segments include corporate, small business, and public. Again, so that's basically the description here. So again, let's get right into it here. First thing I would mention, again, I really like that industry, and when it comes to renewables and a growing population in general, I think that this is an area that's going to continue to grow, right? Because the more people we have, well, the more power we have. And again, if we're going to transition to renewables, that stuff is heavily reliant on being able to move electricity, for lack of a better way of putting it. And again, a lot of people get hung up on a lot of the more sexy names, for lack of a better way of putting it. But in my opinion, it's names like this that are going to benefit because they're the backbone of the system. So again, getting a little bit deeper here. Analysts, again, fairly bullish. Earnings are projected to go very, very a lot next year, I guess, 35%, which is crazy. Again, the average analyst rating on this stock right now is 272. And again, the stock is currently at about 237, 238. So again, that's noticeable upside. I'll get into my fair price here shortly. Again, if we look at its financial health here, again, it's okay. The current growth is definitely not great, but again, the earnings over the future are still projected to grow. So that is a one-off as far as I can tell, at least. Management, again, does a very good job. Profitability-wise, they're good, not great. Again, if we look at its valuation, it is slightly, actually, depending on which number you go by, it's basically right around its historical price of free cash flow. It is above its historical PE, and it is also above its historical price of sales. So if we get into the financials here, again, this is pretty much the bread and butter. This is pretty much the most important part here. So again, liabilities $11.2 billion on a $35 billion market cap. That's not bad. I would prefer it to be lower, but that's certainly manageable in my opinion. If we look at the income statement, again, very important here. The first thing that really jumps out to me is the diluted shares outstanding. I mean, they've been buying back a significant amount of shares going back to 2014, right? So for the last 10 years, the diluted shares outstanding have gone from 173 million to 136 million. So that's got to be what, like a 15%, 20, maybe even 20% drawdown, right? So they're buying back whatever, 1.5%, 2% a year, whatever that number works out to be. That's a good amount, and I think that they can manage that because, again, they do have a solid free cash flow yield. Again, like I mentioned, this is a important metric when you're looking at stocks because that number is very important. Again, and the last thing I'll bring up here, again, the metrics. Again, this is one of the other very important things that you look at. The profitability, again, it definitely could be better. Like it certainly could be better, but it is still growing over time, right? I mean, it is still growing slowly, but again, it is growing, which is good to see, as you can see in the chart here. And again, it definitely is kind of cyclical, but it is growing. If we look at its historical return on equity, return on invested capital is less sporadic. Again, 18%, 15, 25, 23. Again, those are very good numbers. Not the best you'll ever see, but those are good numbers. If we look at its free cash flow per share, this is pretty much the bread and butter. Of all the metrics, this is probably the most important one that you want to be going up, because this is basically how efficient is the company you're looking at. And again, this number, again, a very clear upward trend, which is exactly what you want to see. So again, if we get into its dividend here, again, this is another thing that I really do like. Again, just over 1% yield based on free cash flow. The payout ratio is about just under 23%. As you can also see here, this company's absolutely destroyed the S&P over the last decade. It is up 919% over the last decade. If we look at the last 5 years, let's check that out just for curiosity. We're up about 139 as opposed to the S&P's 87. So again, easily outperforming the S&P historically. Again, the dividend growth is one of the many things that I really do like. Again, they've grown it at 16% over the last 5 years, compounded annual growth rate. I don't think they'll be able to manage that quite that high, but could they get like 12, 13? I think that's reasonable, and that's still a good amount of growth. Again, if you'd have bought this company 10 years ago, you would have over an 8% yield on cost, which is phenomenal, right? That is absolutely amazing. So let's get into the valuation here, because this is very important as well, because just because you have a good company doesn't mean that you should be buying it. You got to make sure you're keen on the valuation. So let's try and develop a fair value for this company, right? So if we look at its, again, based on these numbers, the latest price to free cash flow about 23.5. The 10-year average is 23.23, so it's almost right on that. Based on price to operating cash flow, it's a little bit above that. Based on PE, it's significantly above that, 23 as opposed to 28. Let's get into it and see. So again, over the last 10 years, roughly, they've grown free cash flow 22%. And if we look at the numbers here, again, that number's gone as low as about 12%, as high as like 40%. So let's say, I mean, heck, let's say they grow it at 12% again, which is I think reasonable. I mean, if anything, that might be a low end estimate, but we want to keep the estimates conservative. Let's say they're going to buy back 1% of the shares, which it's looking like they're going to do more, but again, let's be conservative here. Let's say they grow the dividend 12% per year, and again, they trade for a 22 price to free cash flow. Actually, let's adjust this. So let's say they grow at 10%. Let's be extra conservative, just because I don't want to be too aggressive whenever I'm doing these kind of things. We're going to say 10% dividend growth rates and 20 price of free cash flow. I think that, again, if anything, those numbers are conservative. So if we go based on those numbers, again, according to this discounted cash flow calculator, we're going to grow at 10.73% per year. Fair value is just under 7% above where it currently is at. So this is why I really like this stock, because I don't think it's overvalued right now. Again, according to this, again, I'm not an expert necessarily, but again, according to this, and not to mention too, according to these analysts, the analysts are even more bullish than I am. So based on these numbers, if anything, this company is overvalued undervalued. And this is why I'm currently dollar cost averaging very slowly this company, right? Very slowly. Most companies, that's how I do it, because again, unless we get like a major drawdown, I never like to be too aggressive. I like to ease my way into positions. Again, that's just me. If you do it differently, that's me. I guess that's okay. But so again, that is CDW. Again, I'd love to hear other people's opinions, but again, I really like this area of the market. I think that this is a underdeveloped and an underappreciated area. There's a lot of people that are focused on the wrong kinds of companies, in my opinion. And if you look at this kind of industry, I think it's an absolute no-brainer that this industry is going to grow very, very... I don't think you're necessarily going to get rich. I don't think you're going to get a 900% return over the next decade like you have in the previous decade. But I think that it's more than likely that you not only do you get good returns, but you outperform the market with a company like this. And again, a very important thing that I look for in companies, which again, honestly, I don't know if there's data backing this up or not. This is just how I feel, and this is just something that I like personally, is a company that pays dividends. The current yield isn't that high, but it's growing it very nicely. Again, that's just me. Again, like I said, I don't know if there's necessarily any data to back that up, that over the long run will outperform the market. But it's something that I really like, that you buy a company and they pay you back. Not only are you buying back shares, which adds value, but they're also growing that dividend. Because again, if you have a 1% dividend right now and you grow it at 15% per year, that means that you're doubling it about every just under 5 years, roughly. So if it's 1%, well, 5 years from now it's going to be 2%. 10 years from now it's going to be 4%. 15, it's going to be 8%. Now again, are they going to be able to do that over 20 or 30 years? Probably not. But again, if you can simply hold a company and have a 5% yield in 10 years, and in an area that's still growing, to me that's a no-brainer. And again, worst case scenario, right? Worst case scenario, you just hold the company, you take those dividends, and you redeploy the capital, or hell, maybe you sell the company, right? But I just like that. Again, just me. I'd love to hear other people's opinion on the topic. But again, that was CDW. Again, a company that I really do like, and not to mention too, I think that the average investor is overexposed to large cap companies. Now again, depending on which definition you're going on, this company is a large cap, 31 billion. I think that's debatable. I mean, by the official definition, I believe it would fall under a large cap. But when I say large cap, I'm talking about companies that are in the hundreds of billions or trillions of dollars in valuation. Like we're talking the top 10, 20, 30 companies in the world. Those are the ones that people are overexposed to. Now, a lot of people also will bring up, the Meg 7 makes up whatever 25 or 30% of the S&P, but that's not completely out of the ordinary. To be fair, you got to be careful to not take what I'm saying out of context. And again, you hear a lot of people bring that up. The Meg 7 is X percent. That this is so crazy, but it's like Warren Buffett. I mean, personally, I know he has said that. Literally 10 stocks out of the probably, I think he said 400 or 500 companies he's owned have accounted for the majority of his returns over time, right? So that is quite literally like saying that the top 10 companies are 50% of the S&P. I mean, for Warren Buffett, that's how he did it. Now again, it's one guy. That doesn't necessarily prove that's how you should invest. But again, I'm kind of giving both sides of the argument here. I think that, again, people are too exposed to the NVIDIAs, Googles of the world, like those mega cap. But again, I'm also pointing out the other side here, that you really should have some small cap and some mid cap. But on the flip side, I wouldn't panic. But you also have to keep in mind that a lot of these people, the last thing I'll leave it on here, a lot of people they'll buy like the QQQ, they'll buy the SPY, and they'll buy VTI, thinking that they're diversified, but they're really not, because those ETFs are very similar, the top holdings. So that's my whole point here, is that when you're going to diversify, you want to diversify with companies like this, and the reason for that is these kinds of companies are underexposed in the indexes, especially the big ones. So if you're going to buy individual companies, in my opinion, you should be buying the smaller and the mid caps. And the reason being is that those are the ones that are going to drive the really big gains. So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe, and stay tuned for more.